Hello and welcome back to the American Dream Portfolio. In our first 23 videos, we have tried to build a foundation of purpose, reasoning, and knowledge that can lead viewers to start where they are, with what they have to reach for the American dream. Even if you are living outside of the United States and have a very modest income, this dream can be yours. But the dream, regardless of your particular circumstances, will almost certainly include a journey towards financial independence, which is the ability to support your lifestyle without having to work. How can this dream be accomplished? Well, we have already discussed the importance of building a hard-working portfolio of assets that has the following characteristics. Number 1. It achieves an average annual rate of return equal to 9% or better. This will provide a solid inflation-adjusted or real growth rate of at least 6% at the current 3% inflation. Number 2. Its performance must be assessed alongside a strong and durable benchmark. Our chosen benchmark is the S&P 500 index, but you could also use the total US stock market index. Number 3. Its initial construction and any alterations must be reasoned and systematic, and based on the purpose and assumptions outlined in the previous video. Emotion and ego must be kept to a minimum. Remember, we are in the market to make money, not to be right. With all this in mind, we return to the question we posed at the end of the last video. Why can't our American Dream portfolio consist only of our benchmark and nothing else? After all, the S&P 500 benchmark meets all of our requirements. It's hard-working to the tune of 9% per year on average. It's durable and with restrained volatility, and it's an elegantly simple solution. In short, if our portfolio consisted only of an S&P 500 index fund, we would never have to wrestle with making any changes. It would be the investment portfolio's version of a one-trick pony. All by itself, the S&P 500 could get us to the American dream. In answer to that question, we propose the following. Our portfolio could indeed consist only of the S&P 500 and nothing else, provided we are content with forgoing the potential returns of creative destructor stocks and other high achievers. In a previous video series, we outlined the breathtaking performance of stocks issued by life-changing companies such as McDonald's and Amazon, as well as by companies that may not be life-changing, but that execute with excellence, including companies like Nvidia and Caterpillar. If our portfolio can capture the performance of some of these companies at least some of the time, we may realize a supercharging of our results and a portfolio that outperforms the market. Doing so would hasten our progress towards achieving the American dream and is, therefore, a very worthy pursuit. But it is not for everybody. In upcoming videos, we will attempt to construct such a market-beating portfolio, but along the way, we will show how investment in individual stocks, no matter how promising, increases our risk. So for now, let's set aside the excitement and the risks of a hard-charging portfolio and focus, instead, on what an S&P 500 only portfolio would mean. This price chart shows the performance of SPY, a widely recognized and widely available S&P 500 index fund over the last 20 years. Purchasing SPY gives you all the benefits and all the risks of investing in the S&P 500 itself, but with dividends reinvested. This chart shows that the index experienced several significant moves, both up and down since 2006, but in the end, it secured a total return of 762%, as shown in the upper right corner. This represents an average annual return of approximately 11.37%. Comfortably above our 9% target. So far so good, but as we stated in an earlier video, investing, even in a dependable benchmark like the S&P 500, is not all peaches and cream. Let's delve more deeply into this chart by picking out two intervals that were frightening and two intervals that added bounty to our bottom line. The first frightening interval, from October 2007 to March 2009, encompasses what has been called the Great Financial Crisis. The word crisis is often overused, but not this time. Let's look at the chart from this truly desperate period in history. This chart shows a rollercoaster ride to oblivion for the S&P 500. In the lower left corner, you will note that the index collapsed during this interval, losing 55% of its value. Ask yourself this question. Would I have hung on to my investment during this crisis? Or would I have been frightened enough to sell? Remember, in a previous series, we discussed investment risk, or the likelihood of selling your investment at a loss. Many investors sold their positions at a loss during this crisis. Such fear is understandable. But if you are to secure the wealth-building potential of the S&P 500 over time, you must remain invested through good times and bad. This chart is as bad as we've seen in the stock market since the 1930s. What happened next? Beginning in March 2009, we see that the market sprang back to life with a vengeance. From March 2009 to May 2015, the S&P 500 gained over 250%, as shown in the upper right corner of the chart. Had you been frightened out of the market during the previous period, you may have missed some or all of this incredible advance. Okay, what about another scary time? How about the market crash tied to the 2020 COVID pandemic? Let's take a look. This chart shows that in just 5 short weeks, the market lost over 1/3 of its value. Can you hang on to your benchmark investment during such a frightening decline? Only those investors who can are suited to holding a hard-working and steadfast performer like the S&P 500. Okay, we will finish on a happy note. How has the market performed since recovering from the COVID crash? The next chart will show us. As you can see, the market has rebounded impressively since the depths of COVID. Even with post-COVID inflation fears in 2022 and the market being rattled by President Trump's tariff agenda in 2025, the S&P 500 still gained over 260% in the last 6 years. So what do all these charts tell us? Well, we think they help prepare us for the rollercoaster ride of results that we can expect, even from a stalwart investment like the S&P 500. If it's your goal to build wealth, then you will have to come to terms with the volatility we have shown you in this video. If you can do that, you may be well on your way to reaching for and achieving the American dream. In our next video, we compare our benchmark S&P 500 with bonds, an asset class that isn't quite so scary, but is a calmer and more stable investment, necessarily better. We'll find out. See you next time.